Warren Buffett likes to point out how he beats the market when stocks languish, but he won't be saying that about 2011. Betty Lou has the story. Betty?
That's right, Margaret. You know, Buffett is known for saying that his company is so big, growth won't be as fast as in the past. But this past year, he's basically underperformed, down about 5%. Only the second time since 1990 that he's lagged behind the S&P 500 index. So why is this? Well, there's been a variety of factors. An unusual rise in insurance claims given these natural disasters that we saw back in 2011 in Japan, for instance. Losses on the derivative contracts that he's underwritten, and also the resignation of his right-hand man, David Sokol. That was a lot of controversy at Berkshire Hathaway. And then there were some of his investments. Wells Fargo, for instance. Berkshire is the bank's biggest shareholder, and Wells Fargo fell 22% the first 9 months of the year. Still, we did see Wells bounce back in the fourth quarter, gaining 19%. Buffett himself has lost about $2 billion last year in his own personal holdings of Berkshire. But as always with Buffett, and he says this too, you have to take a larger look at his performance against the S&P. In the last 21 years, while the S&P has almost quadrupled, Berkshire Hathaway stock has risen about 1,600%. And that's why he's got all those Buffettites that come out to Omaha every year, because they have made a lot of money with him through the decades, Margaret.
Well, Betty, I know you've been talking to hedge fund managers who had a pretty tough year themselves. What are they saying about Buffett?
Oh, yes. A lot of them, as you know, or several of them have had pretty tough years, double-digit losses. Now, Buffett, he's unique, Margaret. You know, he's built a company where he gets permanent cash, and he can use that to buy whole companies. We've seen him do that with Burlington Northern. He's bought solar companies recently, or a solar company recently. That makes his book value a bit less sensitive to a declining stock market, and you could say that that could protect investors' money. That is unlike a hedge fund that is fully exposed to the equity markets. I was having a lunch with one manager who's lost about 20% last year, and he says, look, this Buffett model of having permanent cash, even a down 5%, that's looking pretty good. Back to you.
All relative. Thank you very much, Betty.